Good day, ma'am. We are from BSMA 3-1 and we are here to present to you our final requirement about business combination and intercompany. To begin, let me first introduce to you our group and our assigned tasks. I'm Marcel Hugilon, together with Isagani Ramos, Anjali De Leon, and Crisel Ann Santos. We are assigned in the discussion of the topic, while Januel Rojas was assigned in encoding, and Charlon Denzel Sansano was responsible in making the PowerPoint presentation. To start the discussion, let me first define what is business combination. Business combination outlines the accounting when an acquirer obtains control of a business. Thus, there are two different companies with separate operations and books before the combination. In a simple manner, business combination is done when a certain company is bought by another company which is the acquirer. Here are the reasons why business combination is done. This is to reduce the potential competitors. Basically, if the acquirer bought a certain company, automatically it reduces one competitor. Another one is to obtain new management strength because the acquirer has gained an ally. And lastly is to have income tax advantages. Here now is the types of business combination, which are net asset acquisition and stock acquisition. Let's start with net asset acquisition. Net asset acquisition is the acquisition of the total assets and assuming the entire liabilities of a certain entity that the company wishes to acquire. Thus, the acquirer is required to be dissolved. There are two scenarios in net asset acquisition, wherein statutory merger, only one company will remain, while in statutory acquisition, a new company will exist. Stock acquisition, on the other hand, the acquisition of the shares of stocks, which means there is no transfer of assets and liabilities and each company's books will continue to operate separately. In stock acquisition, both companies will still exist but will operate separately. At this moment, Isagani will now present.
Hi, I am Sagani Ramos and I will be discussing acquisition method. Acquisition method requires identifying the acquirer. In net asset acquisition, the company transferring cash or other assets and assuming liabilities is the acquirer. In stock acquisition, the acquirer is the company transferring cash or other assets for controlling interest in the voting common stock of the acquiree. Determining the acquisition date. Acquisition date is the date on which the acquirer obtains control the acquiree. It is important because on this date, the fair values of the identifiable assets acquired and liabilities assumed are measured. The fair value of the considerations transferred is measured. The goodwill or gain on bargain purchase is calculated. Determining the consideration given or the price paid by the acquirer. The consideration given is generally assumed to be the first fair value rather of the acquiree as an entity. IFRS 3 requires the consideration given as the sum of acquisition date fair values of the the assets transferred by the acquirer, the liabilities incurred by the acquirer to former owners of the acquiree, and the equity interest issued by the acquirer. Kinds of consideration. Contingent consideration. Usually, an obligation of the acquirer to transfer additional assets or equity interest to the former owners of an acquiree as a part of the exchange for control of the acquirer if specified future events occur or conditions are met. Acquisition-related costs. The cost the acquirer incurs to effect a business combination such as brokers fees, accounting, legal, and the professional fees, general administrative costs, including the cost of maintaining an internal acquisition department, are not included in the price of the company acquired and are expensed. Stock issuance cost. When the acquirer issues share of stocks for the net assets acquired, the stock issuance cost such as sec registration fees, documentary stamp tax and newspaper publication fees are treated as deduction from additional paid in capital or APIC from previous share issuance. In case APIC is reduced to zero, the remaining stock issuance cost is treated as contra account from retained earnings presented in as separate line item. Recognizing and measuring the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree. The fair values of all identifiable assets and liabilities of acquiree are measured and recorded. The total of all identifiable assets less liabilities recorded is referred to as the fair value of the net assets. The identifiable assets should never include goodwill that may exist on the acquiree's books. The only goodwill recorded in an acquisition is a new goodwill based on the price paid by the acquirer. The fair value of the net assets recorded is not likely to be equal to the price paid by the acquirer. There are also assets and liabilities that are not recorded at fair market value, which are contingent liabilities, income taxes, employee benefits, indemnification assets or liabilities, reacquired rights, share-based payment awards, non-current assets held for sale. Recognizing and measuring goodwill or a gain from a bargain purchase. Goodwill is the excess of the fair value of the investment in the acquiree, including the fair value of the claim of the non-controlling interest over the fair value of the identifiable net assets of the acquired business at the acquisition date. The acquirer must recognize and measure any goodwill or gain from bargain purchase that result from the business combination. The amount of the goodwill or bargain purchase gain if any, is determined using the investment value of the acquired business of the fair value of the net or identifiable assets acquired and liabilities assumed in the business combination. Conforming to the IFRS 3, the acquirer recognizes the consideration transferred, including the contingent consideration at the acquisition date fair value. The acquirer expenses all acquisition-related costs associated with the business combination. The acquirer recognizes all as of the acquisition date separately from goodwill, the identifiable assets acquired, and liabilities assumed in and any non-controlling interest in the acquiree. The acquirer measures the identifiable assets acquired and liabilities assumed at their acquisition date fair values unless another measurement basis is required by IFRS 3. The acquirer recognizes goodwill, the excess of A. The consideration transferred any non-controlling interest and the fair value of any previously held equity interest in the acquiree over B. The net identifiable assets acquired, where this amount results in a deficiency. It is considered to be a bargain purchase gain and is recognized in profit or loss. In general, an acquirer measures and accounts for assets acquired and liabilities assumed in a business combination after it has been completed in accordance with other applicable IFRS. However, IFRS 3 provides accounting requirements for reacquired rights, contingent liabilities, contingent consideration, and indemnification assets. And
I'm
that would
Angeli
be
V. De
all.
Leon,
Thank you
and
for
today
listening.
I'm going to discuss the acquisition of stocks. In the acquisition of stocks, the acquiring company deals only with existing shareholders of the acquired company and not the company itself. With a stock sale, the acquiring company is assuming ownership of both assets and liabilities, including potential liabilities from past actions of the business. The buyer is merely stepping into the shoes of the previous owner, and the business continues on. On the date of the acquisitions of stock, no goodwill or income from the acquisition is recorded by the acquirer. These are to be recognized only in the consolidated financial statements. In the single entity, the cost of acquisition will be shown as investment. Upon consolidation, this investment will be removed and replaced with the assets and the liabilities of the subsidiary, with the difference being recognized as goodwill. After acquisition, subsidiary will not be dissolved and will form a parent or subsidiary relationship. That will be all. Thank you.
Hi, I'm Crizel Ann Santos and I will be discussing about intercompany sales, upstream sales, and downstream sales. Intercompany sales. An intercompany transaction refers to a transaction between affiliated companies, that is, between a parent company and one of its subsidiaries, or between a parent subsidiaries. Those transactions between the members of a company group must then be considered and eliminated for the consolidation of affiliates. The accounting staff eliminates these transactions because they represent the transfer of assets from one associated entity to another. The reason is that a company can't recognize revenue from the sale of items to itself. Eliminating the related revenue, cost of goods sold, and profits results in no effect of the company's consolidated net asset. Upstream sales. An upstream intercompany sales are those from subsidiaries to the parent company. When an upstream sale of inventory occurs and the inventory is resold by the parent to outsiders during the same period, all the parent entries and the eliminating entries in the consolidated working paper are identical to those in the downstream case. For example, a subsidiary might transfer an executive to the parent company for a period of time, charging the parent by the hour for the executive services. In this case, majority and minority interest stakeholders can share the profit or loss because they share ownership of the subsidiary. Downstream sales. Downstream intercompany sales of merchandise are those from a parent company to its subsidiaries. For consolidation purposes, profits recorded on an intercompany inventory is resold to outsiders. Until the point of resale, all intercompany profits must be deferred. Consolidated net income must be based on the realized income of the selling affiliate. The transaction is transparent or visible only to the parent company and stakeholders and not to the subsidiaries. An example of a downstream transaction is the parent company selling an asset or inventory to a subsidiary.